Alright, hello everyone. We're back again with another valuation walkthrough. Before I get into it, I want to say thank you to everyone that's commented on the videos and at Old School Value. I appreciate your feedback and your insight. I feel I'm a better investor now than I was a month ago. And whether that's true or not remains to be seen, so please keep them coming. My goal with these videos is to share my thoughts and improve my skills, and without you, I can't do that. Thank you to everyone that's subscribed. Only 2 companies in. We've already got 31 subscribers, which I think is very cool. I didn't expect to have any. I was just putting these out there and didn't think anybody would watch them. And it's nice to see that people actually take the time to watch these videos. It also forces me to step my game up too. So I'm putting a lot more focus into the companies now. The more subscribers I have, also the more motivated I am to make these videos. And I'm also glad for the feedback, so keep it coming. I appreciate all of your comments. I read through them all the time, and it challenges my thoughts, so I appreciate it. Thank you. And my goal with these videos is to probably do these every 2 weeks or so. I think that's a fair time to go through a company. It helps that you guys are out there putting companies out there for me to see, so that I can find companies a lot more quicker, so the search process is a little bit quicker. So I think 2 weeks is a good time frame. I'll try to get them out as much as possible. The first couple were easy because these were kind of companies I already had on my list to do. So it's getting a little bit more slim pickings out there for companies that I can do. But it does take time, and I appreciate all your feedback. So thank you for that. I guess the last thing I want to do is I want to thank Jay at Old School Value for promoting these videos. He's really done something special with that website. It's a top-notch place to go to learn about value investing and the ideas out there. If you haven't gone to his website at oldschoolvalue.com, I suggest you go there and read through a lot of the thoughts, not only of Jay but of everybody out there. There's some wonderful thoughts out there from just regular people. So I encourage everybody to go there and support the site and learn as much as you can from it and contribute as much as you can to it. Of course, most of you already know that, and most of you have come from Old School Value, so you already know what the value of that site is. And I know that because I can look at my view counts and I can see my view count spike as soon as Jay posts it. I usually only have about 1 view on these videos before Jay posts it out there, so thanks Mom for that view. But anyway, sorry about the tangent. I want to get into a company today that has a special place in my heart. It's actually the first company I actually did a value investing approach on, and that was back in 2010. The company we're going to look at today is called Food Technology Services. And while I'm loading that up, I also wanted to show you how quickly I can get the data in. So I was on Oracle, and now I'm going to run through Food Technology Services, which their ticker symbol is VIFL. So while that's loading up, we'll talk about the company a little bit and how I got into it. As for my background, I had a finance degree from a large university, and in that finance program I spent 4 years hearing about how efficient the market was, and you can't beat the market, and you got to use CAPM, and you got to diversify, and use beta, and all those traditional modern portfolio things. And they had a lot of academic studies around them, and they backed it up with these studies and these numbers. So I went with it for a long time, and I thought, well, just going to index, try and lower my cost base as much as I can, and get on with it and ignore my portfolio. Then I got my MBA, and my professor challenged these thoughts. This was in 2009, and he challenged the efficient market theories that I had, and it really changed my thought process on how I look at companies. I didn't really consider looking at the company's financials. I was looking at correlations and betas and all that stuff that's popular on Wall Street, but I never actually looked at the fundamentals of a company. And it was at that point that I started to do this, and I really got into value investing. And I really started to find as much stuff as I could, from Buffett to the Intelligent Investor to Old School Value to all these other resources that are out there that talk about this subject. And it really changed my thinking on it, and hopefully by going through these videos, I change your thought processes a little. Maybe I don't convince you that I'm right, but maybe I challenge your thought process enough that you can develop your own thoughts on investing. Sorry about the tangent. Let's get on to our company here. So as I said, it's Food Technology Services Inc. They're a small company, very small company. They have a market cap of about 14.5 million, and they're in a pretty unique business. What they do is they do irradiation on various products from food, so oysters, fruits, medical supplies, so like syringes and contact lenses, and cosmetics. And what they do is they do irradiation on these products. They have one facility in Mulberry, Florida, which is just between Orlando and Tampa, Florida. And let's see if we can simplify what they do. So a company has a product and they need it sterilized. They need to get rid of all the germs, all the nastiness that's in there. So they would send this product to Food Technology Services plant. Then they would run it through their radiation machines, which kill off any of the living things on the product. So basically they're zapping them with this radiation to kill anything that's in there. So bacteria, insects, any type of pests. And what they use is they use gamma radiation. And from high school physics or watching the Science Channel late at night, you know that gamma rays are much more potent than X-rays. So this is the radiation they use to kill what's in the products that go through their process. And then once they irradiate it, it's shipped to wherever it needs to go. So it's a pretty simple business. It's kind of like a car wash. Comes in dirty, it goes out clean. Pretty straightforward on what they do. And they're a pretty small business. They only have one plant. So I read the annual report, and the annual report this is the first one I actually read on a company that I was looking to invest in. So it was kind of special to me, and there isn't a whole lot to do. So if you're looking to start reading through annual reports and do these financials, this is a perfect company to read through. It's very simple to read. They don't have very many different product lines like Oracle. When we went through last week, they had 40 different product lines out there that we had to learn and understand. They don't really have that. Stuff comes in, stuff goes out. They kill the bad stuff with radiation. That's about it. So this is a perfect annual report, a starter kit, if you will. So I think that brings us to an important point too. When you look at companies, I think the value investor has an advantage over other investors in small companies like this. The company usually focuses on one thing. There isn't a lot of clutter in the report. And the numbers are usually small enough that you can wrap your head around them. You can get a feel for what they do a lot easier, and you don't have to worry about how an interest rate swap tied to a yen rupee future, with a warrant expiring if LIBOR hits 3%, but is flipped if it's 3.1%. I mean, you don't have all that crazy financial engineering. You have a lot of junk in the annual report to go to. So it's pretty simple, and all it really does is it takes time to go through it. Plus, in these arenas, you don't really have the big boys playing in your sandbox. So you're not going against Buffett or Ackman or Einhorn or Soros. They don't play in this arena because it's too small potatoes for them. They can't even move their needle. Okay, sorry about that. It's another tangent I went on. But anyway, so I said this was the first company I actually went through, and I love this company. I had dreams of going out and getting enough money to buy the whole thing as soon as I saw it, and I thought this would be my Berkshire. So it's I thought it was a great company when I first read into it, and I thought it was great. Actually, when I bought it, it was trading at about $1.70, and it quickly moved up to a double, and I thought, awesome, value investing works. And it went up a little over 3, and I sold it, something like 2 months later. And then I looked at it maybe 6 months later, and it was at 8. So I bailed a little early. I got a little too anxious with it, and took my double a little too early. But I was still learning. I didn't learn how to sell at the right time. But it jumped up, and I thought it was still a good company. And it came up on a screen I saw a couple weeks ago. So I wanted to do this one because it has a little special place in my heart. So let's see if it is a good value. As we said, they're a radiation company. So basically what they do is they clean up all the dirty stuff in a company. So we're going to start on the statements, of course. as we usually do. And we're going to start with the balance sheet. So you notice right away a lot of different things. Not a whole lot on here. A lot of little numbers on here. As I said, they're a $14 million market cap company, so all the numbers are going to be relatively small. So the first thing we notice is we see a nice buildup of cash here coming since 2004. They're up to $2.2 million in cash that they're building up nice and slowly. Very nice. They have some receivables building up, not too bad. There's just not a whole lot on here on the current asset side. Some cash and some receivables. As you'll notice, they don't have any inventory, so there's nothing they really need to sell. The stuff that's going through their plant is not their inventory. It's not their stuff. So that's a good sign that we're not going to have capital sitting on the shelves. It's just really the machinery and the buildings that we have as an asset that we really need to worry about our capital being tied up in. It's just really this building here at $3.5 million, the $2.1 million in machinery, and then we have this $6.8 million in other fixed assets. This would be their radiation product, which is cobalt-60. They use cobalt-60 to generate the gamma rays to irradiate the products they use. So the $6.8 million is almost entirely composed of that. So on a total of assets, they have $12.6 million on the books, but net that all down, it's only $5.3 million. So they've depreciated all these assets down to $5.3 million in assets. So we're at about 3 times book value, maybe a little less than that. We have some goodwill and some other intangible assets out there as well. Or, I'm sorry, we have, that's not 3 times book value, we have 3.2 and 5.3. Total is $9 million in assets. So we're trading about 1.5 times book value, which is a lot more attractive than what I had said before. So we got $9 million in assets. So let's take a look at our liabilities. They don't have any liabilities. They've got nothing. I'm sorry, they've got a little bit here, just a little bit, and you can't even see it, it's so minuscule. So they've got $24,000 in accounts payable and $127,000 in accrued liabilities. So basically they got a light bill and some salary payable sitting out there as debt. Look at this, no long-term debt at all, none. They own all of those assets, all of those $9 million in assets, they own it outright. They have not had to go out and finance their operation with any type of debt, which, as we said with Bed Bath & Beyond, is a pretty nice thing that they've been able to go out and operate without having a lot of debt. And I think this is even more important with a small company than it is with a big company. A small company has much less of a economic moat, just based on sheer size, than a larger company. So they should have a little bit more cushion in their financial statements, and having no debt is certainly a nice cushion to have. So we look at, obviously, retained earnings is negative. So they've been operating at they had a net loss for quite a number of years, and they've been slowly burning that away, or whittling away that negative retained earnings number for a couple years now. And it's slowly coming down. So we end up at total equity of $8.9 million. It's pretty much the same as our assets. So let's look at our cash flow statement. Actually, let's go to the income statement first, and we'll build off of that first. So let's look at the income statement. How's revenue doing? Started in 2002, we had $1.2 million in revenue, jumped up, well, a little dip in 2004, but since 2004, it's been pretty consistently growing year over year over year. We're up to now $4 million a year in revenue, annual revenue. So revenue's been steadily growing. If we average this out, about 10% a year revenue growth. It actually comes out to about 13% revenue growth on a compounded basis. How about our cost of revenue? How's our cost of revenue gone up? It was at 400,000. So it's been steadily